Welcome to Breaking News to Trading Moves. Today we're looking at a major move in the consumer world, something that really gets into the kitchen and the grocery aisle. We're talking about Keurig Dr Pepper's proposed acquisition of JDE Peet's.
And this goes beyond just a simple corporate merger. Our goal here is to really look at the mechanics of the deal, the economic factors that are pushing this kind of consolidation, and, most importantly, identify the publicly traded companies that are affected. Who are the beneficiaries and who's facing some new challenges because of it?
Okay, so let's just lay out the foundational facts. Keurig Dr Pepper, we can call him KDP, is making an all-cash takeover bid for JDE Peet's. And the number is big. It's valued at about $18 billion. That scale alone says a lot.
It really does. When you see a transaction of that size in a sector like consumer staples, you know the motivations are serious. The offer itself is for €31.85 per share, but what gives this deal such a high probability of closing is the investor commitment.
Right, I saw that.
Yeah, investors holding about 69% of JDE Peet's shares have already agreed to sell. That's practically a done deal right there.
And the timeline seems pretty straightforward. They're targeting a close in the second quarter of 2026. And it sounds like they've already gotten some key competition clearances. So that what seems clear, the why is, well, it's more complex, and it says a lot about the economy right now.
The main driver is a need for more scale to manage instability. It's really that simple. We've seen coffee input costs hit multi-year highs, and this isn't just a normal cycle. We're seeing some real structural pressures.
Can you talk a bit more about those pressures? Why are the coffee beans themselves causing so much activity?
It's a mix of things, climate and trade, really. You've got major producing regions, think South America, Southeast Asia. They've had serious droughts. That tightens the supply of both Arabica and Robusta beans. At the same time, you have all this tariff-related volatility that makes long-term buying pretty risky.
So for KDP and JDE Peet's, merging just gives them more power.
Exactly. More buying power. They can hedge more effectively, negotiate better shipping costs, better processing costs. They can do all of it much more efficiently together than apart. In this environment, scale is about survival.
That makes sense from a supply chain view. But there's another piece to this, sort of financial engineering part. The plan to split the company into two separate businesses after the merger. One for coffee and one for everything else.
Yeah, this is what's often called a portfolio unlock, and it might be the smartest part of the whole deal. Think of it this way. Right now, KDP's soft drink business, Dr Pepper and all that, it's very stable. It kind of hides the commodity risk that's baked into their coffee business.
Ah, okay. So the ups and downs of coffee futures, the climate risk, all that gets smoothed out by the steady soda sales?
Precisely. So by splitting them, you isolate that coffee business. Investors who want that high-growth coffee exposure and are okay with the commodity risk, they can buy into that new company. And then you have investors who want stable, defensive cash flows. They can invest in the pure-play beverage company. It lets the market value each part on its own merits.
You mentioned the $18 billion price tag. That always brings up questions about debt. How are they handling that?
They got ahead of it. KDP lined up $7 billion in financing from private equity partners ahead of time. That helps keep the balance sheet in check, and, it quiets down any immediate concerns from investors about their credit rating.
So if we look past the two companies involved, this deal creates two pretty clear themes that traders and investors can watch in the broader market.
That's right. The first one is obvious: consolidation. When two big players combine like this, their buying power is just the start.
Where else does that pressure show up?
It shows up on the retail shelf. It pressures the competitors. This new, bigger company can walk into a supermarket and command more attention. They can get better shelf space, more promotional displays. All of a sudden, every other packaged coffee company is facing an opponent with unmatched scale.
And the second theme is that coffee inflation we keep coming back to. We know the input costs are high, but how does that become a theme for other companies?
It puts everyone's margins under pressure. Packaged coffee, cafes, fast food chains, anyone selling coffee. In an environment like this, the single most important factor becomes pricing power. Can you raise your prices without your customers walking away? This merger is both a reaction to that battle and, well, an escalation of it.
Oh, so let's turn to who actually benefits from all this. There seem to be three clear categories of winners. First up is the at-home coffee ecosystem.
Right. This group is set up perfectly for what you could call the trade-down effect. As inflation bites, maybe that $5 daily latte becomes a luxury, so people start brewing more coffee at home to save money.
And the combined KDP, which trades under the ticker KDP, is an obvious winner there. But who else in that ecosystem does well when people brew at home more?
Well, anyone who sells the equipment or provides the shelf space. So that includes a company like Newell Brands, ticker NWL, which makes coffee makers and other supplies. But the real structural winners are the giant retailers.
So you're talking about Walmart, ticker WMT, and Costco, COST. How does a big merger like this help retailers who are already so dominant?
It helps them in a couple of ways. First, they can use their own massive scale against the newly combined KDP to negotiate even better prices. They move so much volume. And second, all the promotions that KDP will be running to gain market share, that drives a lot of foot traffic into their stores. And that traffic helps the retailers sell their own high-margin private label coffee.
That's a great point. Okay, category 2 for the winners, the deal-making and financing platforms. An $18 billion deal means a lot of fees for Wall Street.
Oh, absolutely. These cross-border mergers are incredibly complex. They need advisory on valuation, on regulations, on structuring the debt. That's all business for the big investment banks.
And the names here are the usual suspects, the ones that thrive on these big, complicated deals. Goldman Sachs, ticker GS, Morgan Stanley, MS, JP Morgan Chase, JPM, and Bank of America, BAC.
It's core to their business. But the third group of winners is driven purely by the instability itself, the commodity and derivatives volume providers.
Okay, explain that connection. We know coffee prices are volatile. Why does that directly translate to more revenue for platforms like Intercontinental Exchange, ticker ICE, and CME Group, CME?
Because volatility is the engine for these exchanges. When prices are stable, companies can budget easily, but when prices are jumping around because of droughts or tariffs, they can't. So they have to rush to the exchanges to hedge their risk. They buy futures contracts to lock in a price for the future. All that activity, all that uncertainty, it just creates a flood of trading volume. And every trade generates a small fee for the exchange, like ICE and CME.
So the chaos in the coffee fields becomes commissions for the trading platforms. Okay, let's flip the coin and look at the other side. The companies that are now facing new pressure. The impacted entities.
For every winner, there are others who might lose some ground. The first group facing a direct challenge is what you could call the cafe-first coffee chains.
Right, they're caught in that margin squeeze. But how does this new KDP JDE Peet's combination specifically make their life more difficult?
They're getting hit from two sides. On one hand, inflation is raising the cost of their beans, their milk, everything. That squeezes their profits. At the same time, the new KDP is going to be aggressively promoting high-quality packaged coffee in grocery stores. That makes the idea of skipping the cafe and brewing at home even more attractive for consumers.
And that list includes the big one, Starbucks, ticker SBUX, but also fast-growing chains like Dutch Bros, that's BROS, and Krispy Kreme, DNUT. Their customers might be even more price-sensitive.
And you can't forget the quick service restaurants like McDonald's, MCD. They have a huge breakfast and coffee business that's all about volume and value. Any new promotional pressure in the coffee aisle is a threat to them.
The second group facing pressure is pretty obvious. The other packaged coffee competitors. They're now staring down a giant.
Precisely. We're talking about companies that are already big but will now find it harder to match KDP's scale in buying beans and in distribution.
The big domestic players here are J.M. Smucker, ticker SJM, which owns Folgers, and Kraft Heinz, KHC. And you also list big retailers like Kroger, KR, and Target, TGT, who have their own private label brands. They'll have to fight even harder for that shelf space.
It's a tough fight to have, but the third category of impacted entities is maybe the least direct. Consumer brands that are sensitive to promotional wars.
Okay, wait a second. You have names here like Coca-Cola, KO, and PepsiCo, PEP. These companies are enormous. How much can a price war in the coffee aisle really affect them?
It's about how a grocery store's budget works. Retailers often have a total budget for beverage promotions. So if KDP comes in and dramatically increases their spending to win the coffee wars, that money has to come from somewhere. It can shrink the promotional pool available for sodas, for juices, for energy drinks.
I see. So the fight in one aisle spills over by sucking up the promotional dollars for other categories. That would squeeze margins for them even if they don't sell coffee.
That's it, exactly. It forces them into a tough choice. Either promote less and risk losing share, or keep promoting and eat the costs themselves, which hurts their margins. That includes the giants, Coke and Pepsi, but also the high-growth energy drink companies like Monster Beverage, MNST, and Celsius Holdings, CELH. It's a collateral effect of the coffee battle.
So now that we have the landscape of winners and losers, what should people be watching for next to see how this plays out? There are three critical things to monitor.
First thing to watch is any commentary around credit and leverage for KDP. You want to see how the rating agencies and the big analysts react to the final financing package. Look for any changes in the terms, any chatter about credit ratings, or any revisions to that plan split into two companies. A delay there could be a problem.
And the second point is the very thing that started all this, the volatility in coffee futures.
As long as those prices stay high and unpredictable, it creates a headline risk. It puts pressure on the losers, and it validates the strategy for KDP. If, for some reason, coffee prices were to suddenly stabilize or fall, well, some of the urgency behind this deal would fade.
And the final variable is just watching for the competitive response. The other companies aren't just going to stand by.
We need to look for concrete actions. Is Starbucks or Smucker announcing new pricing? Are Kroger and Target shifting shelf space to their own brands? And maybe most telling, do you start hearing rumors of other M&A deals in the beverage space as a response? That would tell you the whole landscape has changed.
So to wrap this up, we've gone through the $18 billion bid by KDP for JDE Peet's, which is really being driven by this need to gain scale to fight commodity inflation and to unlock value by separating out the coffee business.
And this transaction has brought two major market themes to the front: industry consolidation and the strategic fight against high input costs. And understanding those forces really helps you see which companies are positioned to gain and which are now on the defensive.
And we know KDP is planning to split its operations into a coffee company and a general beverage company to isolate risk. So here's a final thought to consider. Given that this is all driven by commodity instability from weather and tariffs, how might the risk profile of that new pure-play coffee company change if future climate events become even more extreme than anyone is projecting today? That's something worth keeping an eye on.
And a quick reminder for you, the analysis here is based purely on the information and opinion of the author of the material we reviewed. This is not financial advice, and it is not a recommendation to buy or sell any security.